Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The trajectory for corn futures remains consistent. After having posted a lower double top, we now found the market in a position where it can potentially challenge 361.5 below. If and when this market's able to come down and break below this 361.5 number, we would be looking for the market to retest previous lows where it could perhaps test somewhere in the neighborhood of 340 to 345. As we move into the weekend, we are now approaching our potential time factor, but one thing to consider is if the market continues to drop going into this time zone, the next potential time factor that we'd be looking at is just after Thanksgiving. In doing so, perhaps the market could decline into that Thanksgiving timeline, perhaps early December, before it's able to finally find a bit of a low, from which point it could then look to find a bounce. Volatility-based resistance overhead played a key role in helping to stall the corn advance, and now that the market is below its 270-degree price factor of 369.5, we now have two key levels that we're looking at. The first would be the Sinusoidal level at about 362, 363, and then below that we have volatility-based support potentially shaping up somewhere in the neighborhood of 350 to 356. If the market again breaks through these areas, especially if it's able to test that 350 number, we do believe a retest of previous lows is potentially probable. We do have a time factor at the end of the month coming in at November 28th, and from that point we would then be able to recalibrate whether or not the market's able to recover from that point. The March contract gives us much of the same, with 375 living right now as potential support. Upon clearing 375, perhaps sometime next week, we would then look for the market to make a move down, and it has its point of control level sitting at 369.5. Below 369.5, we would then look for a nice move to the downside to retest previous lows, coming in at about 355. Soybean futures has been quite a bit of a surprise after making a low after October 31st. The market made a nice advance over the course of 2 days, found resistance at volatility-based resistance, but from that point forward, the market has been range-bound. The market came up and gave us a small pullback, and after that pullback, it actually started to make its way back up again in a V formation. It found resistance once again overhead at 892.25, and after that nice move that we saw on Thursday, the market again has returned to weakness. We would have liked to have seen the market close above the 895.5 number, to give us confirmation of a probable move to the upside that could test overhead resistance near the 9 to 915 mark, but instead the market has reversed again to close out the week, and we believe that the market could very well be headed on its way back down if it's not able to clear the 895.25 number sometime next week. From here, the market would then look to retest previous lows coming in at 860 and 3, and that previous low very close to 850 is where the next point of control lives. Interestingly enough, we see that soybean is able to make its way up into our time factor and now looks to potentially reverse on its way back down. And so if it continues to creep down through the Thanksgiving holiday, we would not be surprised, where the market could very well be range bound and find some support at a point of control level of 868 3/4. Wheat futures gave us some flashes of potential strength when it made an advance that tested its point of control level at 520, but upon touching that 520, the market came back down, and it's been able to actually hold very good support just below at the 505 number that we'd long been talking about. Wheat futures gave us a break below that 505 level briefly, but has since returned and has now been trading inside of the 520 to 505 level over the past week and staying very close to that 505 level predominantly. The market now is giving us what appears to be a weak formation. After having made its highs previously near the 531 mark, the market has come down to the 520 where it found continued resistance. And if we draw the midline between the 505 and 520, we find that most of the highs over the past 2 weeks have been right at that midline, suggesting that we could very well give us one more break to retest previous lows near 490. If the market is instead able to recover and start to make its way back up, that 520 number is going to be key in terms of where it needs to get through. But upon getting through that 520 number, we could see a move in that could very well test 530 and perhaps 540. The caveat, though, is that this market is running out of time, with first notice day coming in about 2 weeks. At this point for the week contract, we anticipate that the market will remain range bound. Historically, the seasonality for wheat suggests that the market would be range bound for the next 4 to 6 weeks at a minimum. And so we're looking at wheat to simply continue to play out, finding support near that 505 number and continuing to find resistance overhead near 520. The March contract in all likelihood will trade in a similar fashion, but the caveat for the March contract that we are seeing is that the recent highs are in conjunction with previous lows, suggesting that the March contract may be weaker than that of the December contract. That being said, we expect that the market could remain range bound just as the December contract over the next several weeks. And upon breaking its range, can see one more final break that can make a move down to about 490. But if the market's able to hold its own over the next several weeks, we would not be surprised to see the market move to the upside as well. What we'd like to see is the formation that he gives us as we approach that timeline over the next couple of months. But as we approach January for the March contract, the way in which it resolves this sideways consolidation that we've been seeing is going to be key. One of two things that we'd like to see is whether or not he's able to give us perhaps a higher low coming in to break out to the upside that is higher than previous lows. And then the other movement that we would be looking for is if the market comes in and gives us a lower high than the previous highs that it's had, and that would be an indication for a breakout to the downside. The way in which it resolves itself outside of the sideways consolidation is going to be key in determining the next movements for wheat. This week for the US dollar, we are including a view of the price oscillator to give us a feel as to where the momentum strength for the US dollar currently lives. The advance that we saw early in the year indicated that the move for the US dollar was very strong. Since then, the market has broken to new highs, but in doing so, it did so on less strength. This is an indication of divergence where the market, even though it's making higher highs, is doing so on less strength. And that sometimes is an indication of the market weakening and very well turning over. We've discussed before where we were looking for resistance to live somewhere in the neighborhood of the price level of 98. And as we can see, the market has since posted for us an SR2 level, from which point the market has since turned down. We do have an overlap in two of the volatility-based resistance bands that in turn caused the market to come down. And the market now is testing the 96.60 level. And the potential for a breakdown that retests previous lows near 93 or 94 is possible for the US dollar. Previously, we shared on the weekly chart how the market did post for us an N band across the top as it touched volatility-based resistance bands, and we see a very strong reversal for this week for the US dollar. Its ability to recover is going to be very important. If it's not able to do so, a retest of the low end of volatility-based resistance may be possible, with a possible retest of previous lows again near the 92-93 level. We also have the volatility-based support bands coming up from below, and now they're starting to bend, suggesting that a breakdown to that 92-93 level is perhaps where the market would pause, and from which point we can see an advance going from there. In closing, we'll have a look at crude oil futures. We can see here for the December contract, it maintained its persistent drop all the way down to about 55, where it finally posted an N band. And over the last 3 days, we're seeing a small recovery or a small bounce off of potential support near that 55 number. The market did come straight down after several announcements by the current administration voicing their preference to keep oil prices down, and we can see that OPEC accommodated when it backtracked on its announcement of potentially slowing down production. The market continued in a precipitous drop, and we're finally seeing a small bounce, but if the weakness does persist, the market may only be able to make it back up to about the $60 mark. If the market's able to make it beyond that $60 mark, a retracement that's closer to the 270-degree mark may be probable, but that remains to be seen given the strength at which this market has declined. When a market falls with this kind of strength, a 25 to 38% retracement is typically the most that the market is able to produce, but even still a 25 to 38% correction would be quite the move for this contract. Upon making that correction, we would then look for another leg down that would last at least 62% of this down leg. And so we're looking at the potential for another very big move to the downside for the crude oil market. Thank you so much for joining us for our regular market update. Look forward to touching base with you again next time.